Hey, this is Big G, or Gene, or Gino, or Dad, or however you know me. If you ever wonder why I don't speak louder in these videos, it's because it's usually late at night and my wife is asleep in the next room. So hopefully you can hear me okay. And this is lesson number 8 in my little trading series here. And we're going to talk about mind games, how you need to have a plan, and how you have to control your emotions. You recognize this guy on the screen? It's Sigmund Freud. What was he, a psychoanalyst or psychologist or psychiatrist or whatever he was. He was all into the brain and everything. And when I first started trading, I would read some books and I would watch videos and I would hear them talk about trading psychology and the emotions of trading and all that. And to be honest, I didn't think too much about all that because I thought I'm a pretty even-keeled guy. I'm not greedy. I'm not, I just didn't think that the emotions would bother me. But the truth of the matter is, it's not until you get a plan, it's not until you understand the emotions of trading, until you can start doing well. And so we're going to talk about that a little bit tonight, and understand first of all that the two things that drive the stock market are fear and greed. The market panics whenever there's negative news. Whenever there's no news or good news, the market gets greedy, and that's what moves it, and that's what makes things go up and down. And understand that fear and greed are the two main things that drive the market. And of course, those are dangerous emotions. And so you don't want to be afraid, nor do you want to be greedy. And so what do you do about that? How do you handle your emotions? Well, there's 5 things you need um, to overcome emotional trading. You need to have a plan, and we will talk about having a plan later as we go through these videos. You have to have discipline. Um, you have to have a logical, mechanical approach to trading, and that's probably for me the biggest thing. Just a logical approach, a mechanical approach. When you do that, it becomes emotionless. And I'll show you a little bit later how that might work. You got to understand risk. You don't want to risk too much. In fact, you want to risk very little. And you need to learn how to lose, because you're going to lose a lot of your trades, maybe even more than half of your trades, but you can still win less than half of your trades and be a profitable trader. So you need to overcome those things to avoid the emotions of trading. When you make a trade, there's 4 possible results for any one trade. You can have a big win, you can have a small win, you can have a small loss, or you can have a big loss. And the key to profitable trading is avoid number 4. Avoid number 4. Avoid the big losses. It's okay to have small losses. Obviously, it's good to have small wins. It's even better to have big wins. But if you can just understand that you want to avoid the big loss and understand the risk involved in trading and know what you're getting into before you make a trade and avoid that big loss, you'll be good. Ed Seykota is a famous trader, and says he has 3 rules of profitable trading: cut your losses, cut your losses, and cut your losses. And truthfully, that is so simple. It's kind of hard to do sometimes, because sometimes you do get greedy, or you do think, hey, this is going to go up, I just know it is, and you hang on to it too long and you lose too much. But learning how to get out of a bad trade and stay in a good trade is key. He has other rules. He says to cut your losses, you ride your winners, you keep your risk small, and you follow your rules. It really can be that simple. And later in these lessons, we'll talk about coming up with trading rules and having a plan and all that. Here's a chart of GDX. If you've been watching these in order, I think the last lesson we looked at a bunch of hammer candles that showed up last Friday. And this is a chart of GDX taken today, February the 14th. Happy Valentine's Day, by the way. And let me get my little drawing thing out here. And you see this long tail hammer here. You could have, notice how it hits support. Remember support? Here's support down here. So down around $21, you could have come in here and you could have said, I'm going to buy GDX when it goes right over that hammer candle from Friday. This is Monday. That little tiny doji there is Tuesday, and this is today, Wednesday. I'm fortunate enough to have some shares in GDX, so I had a good day today, as you can see. I had a good week so far. But suppose you came in Monday and you said, okay, when the price goes just above that hammer candle, I'm going to come in and I'm going to buy GDX. And then you would set your stop. I would set my stop right around here at 21.25. So your risk is going to be, let's call that, I don't have my little thing, well, let's just call that 21.75, that price there. So 21.75, you're going to get out at 21.25, so you're risking 50 cents per share in this trade. And you would figure out how many shares can I buy. It depends on how big your account is, and we'll go over all that at another time. But you're just risking 50 cents right here per share. That's a small risk for a nice little gain. If you had done that, you would have got in at 21.75. You'd be at $23.01 today, and that's a great little pop right there. So it's all about taking small risk and understanding what you're doing, getting in, getting out in time, and just being a smart trader. Trading is not gambling. Trading can be gambling if you're ignorant and don't know what you're doing, but smart trading is not gambling. You want to be a risk manager, not a risk taker. And so you want to take low risk and have small risk and high probability trades. You see this girl in the picture here, she's showing you how to shoot a layup in basketball. In basketball, the lowest risk shot and the highest probability shot is the layup. I mean, you can make a layup if you're a decent athlete, 9 out of 10 times. So it's a low risk shot. It's a high probability shot. Low risk in that you're not shooting from a great distance. So the chances are you're going to make it. And so it's a high probability shot. You want to do that when you're trading. You want to come up with low risk setups that have a high probability of winning. Just like that hammer candle. We looked at hammers, and you see the success that hammer candle. And if you get on FinViz and go back and look at this week of February the 12th is that Monday, and that Friday was the 9th. And just there's a bunch of hammer candles last Friday, and a lot of them have gone up. So low risk, high probability. Do you know this guy? You need to know what success looks like when you trade. This is Cobb. Cobb played from 1905 to 1928. He still holds the Major League Baseball record of having the highest batting average ever for a career. He batted .366. What that means is he was successful. He got a hit 36%, or rounded up to 37% of the time when he went up to bat. What that means is he was not successful over 60% of the time. And so this is the most successful guy ever, and his batting average was 37%, 366. So in trading, you can win just 50% of your trades and be a profitable trader. Let me show you. What if you only won 50% of your trades? Let's make some assumptions. Let's assume you have $15,000 in your account. Now, let me say that you don't have to have that much money. You can start with $1,000 or a couple of $1,000. But I'm using this $15,000 because when you get over $10,000, you only want to risk 2% of your account. We'll talk about risk and all that a little bit more. But I'm just using this as an example, but don't freak out if you feel like that's a lot of money. But let's just assume you got a $15,000 account. Let's assume you make 10 trades, and 5 of those are winners, and 5 of those are losers. And your risk reward is 1 to 2. In other words, you're risking 2% of your total account, which is $300, and you're going to win. Let's just assume you win 4%, or twice your risk, $600. $600 is 4% of 15,000. Now let's see what happens. You make your first trade, and let's say it's a winner, and you make $600. Second trade, you lose $300. Third trade, you win $600. Trade 4, you lose. 5, you win. 6, you lose. 7, you win $600. 8, lose $300. 9, win $600. Trade 10, you lose $300. You profit in those 10 trades, just winning half of the time, you make $1,500. And of course, this is all theoretical, but what could happen is one of these trades, this might be a 3. You may win 3 times. You may win $900 here. Or maybe this trade you see is going south pretty quick and you get out before you lose the whole $300, and maybe you only lose $100. So all of these can vary, of course, but this is just an example showing that just by winning 50% of your trades, you can be a profitable trader. So you got to have a plan. You can't let emotions get in the way. You don't want to be like this guy or this gal, and you certainly don't want to be the greedy guy down here. You don't want to. You have nothing to fear. Don't have to take. You can take emotions out of it. You can don't be greedy. You want to be like this guy, confident little kid, not a good-looking kid. You can be confident once you know what you're doing. You can control your financial future with a little bit of work. And I like this quote: opportunity is missed by most people because it's dressed in overalls and looks like work. With a little bit of work, with a little bit of study, just spending a few minutes a day watching these videos and watching the markets and just kind of learning how to do it, and just continuing to be a student of the market, you'll set yourself up where you can make some extra income every month, and certainly to set yourself up for a good financial future. So hopefully this is helpful to you. Don't discount emotions in trading. You got to control your emotions. You got to have a plan. You got to be disciplined, and you need a good logical mechanical approach. So I hope this helps, and we'll see you next time.